Welcome back. I'm Tracey Ryniec, Zacks Value Stock Strategist. And this week I am going to talk about value. So Berkshire Hathaway held its first annual meeting without Warren Buffett at the helm as CEO over the weekend in early May. And it was an interesting contrast to what normally happens at the meetings. Sure, all of the fans were still there in Omaha, and even Buffett himself was there in the audience. And he answered a question or two, both in his own form and as an AI agent, because apparently they have fed all of Warren's writings into an AI LLM to create their own Warren Buffett agent that can answer questions on investing as Warren would answer them. But it doesn't really answer all the questions about what's going on at the Berkshire business. Now, Greg Abel is now the new CEO, and he has been on the operations side for many years. Warren Buffett does trust him, so the Berkshire Hathaway shareholders are trusting him right now as well. But we're still in the early innings, and we're just getting a handle on how he might run things. And also, with Buffett still with us and on the board of Berkshire Hathaway, it's likely Buffett is actually behind the scenes running the actual equity portfolio and all that cash. Now, Berkshire Hathaway did say that it has raised now 397 billion in cash. It's sitting there, cash and treasuries, earning around 5%. This isn't a bad deal for them, they feel, because a lot of other assets are overpriced right now. And this has been a Buffett MO many times when the stock market has gotten just what he considers to be too expensive, and he sat on the sidelines. Now we're starting to see some of the behavior from other investors that we saw in the late 1990s about Warren and Berkshire Hathaway. We're not totally seeing the haters on the Berkshire shares, not quite yet, but they are trailing the S&P 500 now over the last year since Warren announced his retirement. So they'll give a little bit of a leeway on that for now. But as we go along, if they continue to underperform, you're going to start to see the attacks on Berkshire coming faster and furiouser, as we saw in the late 1990s. But in the late 1990s, we didn't have social media, and now we do. So people are free to share their ideas about Buffett and Berkshire Hathaway's performance on social media. And we're already starting to see things that are very familiar to those of us who were around in the late 1990s and investing. And that is, Warren is old. He's out of tune with what's going on the markets. He doesn't understand technology. Other than Apple, he really doesn't own any. We're starting to see all of these gripes and concerns. Although in the late 1990s, it was really, why isn't Buffett buying Cisco? That was the big winner of the 1990s, up 10,000%. And many people thought that Buffett had left a lot of gains on the table by simply refusing to buy companies where he didn't really understand what it is they did. So that included a lot of technology companies. And so he was on the sidelines for that. But as I've said many times, he had the last laugh when the dot-com bust happened. He was not invested in those companies. Instead, he was still in a lot of the old economy companies, including the banks, which went on to soar in the next decade up until the financial crisis, of course. But if you bought them in the 90s or even the early 2000s, you saw some really big gains there over that decade. Additionally, as Warren likes the old economy businesses, and Berkshire has always owned companies and equities in that area, including the railroad that he would buy a little bit later. The oil stocks did very well in the 2000s as well, with Exxon and Chevron breaking out to new highs in that decade as oil hit new all-time highs of $147 a barrel, pushing up the earnings of all the oil stocks through that entire decade, including during the financial crisis. So I'm beginning to get some deja vu. Are we going to get a return to these kind of conditions? Buffett always says he can't market time. Nobody really can. And so he doesn't try to, but the cash hoard sitting there is market timing, because with the market returning what it is right now, his portfolio is underperforming while he's sitting in 5% cash. But that money is going to be deployed somewhere, maybe not by him, maybe by Greg Abel coming up in the next few years. But meanwhile, he has big positions this time in oil, just when oil is taking off again. We saw the mini rally in oil during the Ukraine-Russian war in 2022 that boosted earnings of all the oil companies, and Berkshire was already in some of the oil positions then. But he has bought in more, at least in Occidental, since 2022, and now the earnings are starting to turn around again. We have WTI up a little bit over $100 a barrel right now, but that could change at any time. And many of the oil analysts believe it will hold over this 100 for at least several more months. And that means good things for those earnings. So let's take a look today at what is going on with the two oil stocks he owns in the equity portfolio. So the first one is Chevron, and they've already reported earnings. So they have the number one rank again, and that is coming off of the earnings, but also that the analysts were already revising earnings higher going into this report, because the last month of the year is when the Iran war started, and that's when the oil prices spiked. So the earnings were already going to be better. Scrolling down for Chevron, which is big oil. So they have refining, and they have distribution, and they've got the production side, drilling for oil worldwide. And so that aspect of it puts a little bit different view on the business. But you can see on this price consensus and surprise chart, the estimates really surging here now in just the last couple of weeks as the oil price has remained elevated. Now, Chevron has always been one of the better payers on the dividend yield. And right now you can see it's at 7.12, and that's yielding 3.7%. So that's very strong for the energy, because the higher oil prices really haven't made their way through to the free cash flows yet, but I'm expecting them to do so here in the second quarter for sure, and maybe even further along. The big oil companies will mostly keep their dividends as they are, because it could just be that this is a short-term spike, and so they'll keep that as it is. Usually a lot of the extra cash will go to share buybacks with a lot of these big oils, but we'll see what happens going forward. Now, the tale is told on how bad it's been when you look at the sales and EPS growth rate chart here. And ever since the Ukraine war, when earnings spiked, it's been a downward trend. And those oil prices have really come down from around $130 a barrel all the way back down into the low 60s. And there was a push by the White House and this administration to get it down into the 50s, to get even lower prices out there, so gas prices would be lower at the pump. And that's where you see the decline in the earnings that was still expected. If we're looking at the price of consensus chart, this is the 2026 line, this light blue line. And you can see before the Iran war, it was expected to be lower than last year. Once again, just lower and lower and lower as oil prices remain depressed. But that has all changed. But you can see on the sales and EPS growth that we've had the negative earnings 3 years in a row. This year was expected to be another decline, but now we're seeing the big jump, and we're seeing it also on the revenue side. Next year, they're not so positive, and they're seeing a return to, further decline, but that's coming off of now 2026's big numbers, and they are raising 2027. So let's take a look at the detailed estimates, because that is going to give us a better look into what is exactly going on behind the scenes now that they've already reported, and what the analysts are thinking, and how the company is telegraphing what's going on. Okay, so this is interesting. 2026, we still have one estimate being raised since the earnings report. So even though they were already bullish with 7 raising in the last 30 days, and then the war has been going on over 60 days. So these 8 increases are showing what's been happening since the war, even in that 60-day time period. But we do have someone who decided they had to still raise again. They were being too conservative after the earnings. And so we still have estimates rising again. We have 1413 now for this year, and that is up. I mean, it is more than doubled just 60 days ago. And that's how dramatic things can change on the commodity side. We've seen this kind of this year with the gold mining companies, where those earnings have really spiked higher dramatically with the new record price in gold. But now we have not a record price, but much higher oil prices, and that is being translated here as well. So now 1413 expected for this year, still 1210 for next year, up pretty dramatically as well. But 2027 was already expected to be a much better year, and you can see that 90 days ago we had 636 for this year and 844 for next year, because everyone in the industry and on the street believed 2027 would finally see a drawdown in some of the excess inventories, and that would mean prices would go up maybe back into the 80s by next year. But everything has been pulled forward now with this war, and it could stay higher for longer. So we'll see how that results as we move forward through this year. But you can see they can easily now afford that over $7. Let me see if it says it up here. It doesn't. Over $7 was the dividend. They're not going to cut that. They have been paying it, even though, see, last year was at $7.29 is what they made. So they were basically paying out everything into that dividend. But big oil will do that because they're dividend aristocrats, and they are willing to go into the hole a bit for a year or two, waiting for things to turn around. Well, it's turning around much faster than anticipated, and that is helpful for the shares as well. But they will move with oil. So on this mini price and EPS surprise chart, you can see the big moves since the Iran war started. Then the crude prices did come back down to around $80, and the shares were sold off. Maybe it's another buying opportunity here, because the underlying earnings look really good. PE of 13.5, but remember, as the earnings rise, that PE will come down, and especially even with the shares rising, because of the bigger E factor going on there. So in a bull market in oil, we will see lower PEs actually, even as the shares rise. And that's why we've got this PEG ratio of 0.7. So really, Buffett has been very patient with the energies. He has sold some Chevron shares over the last couple of years and like lightened his position there. But he has still been in it, and it looks like this trade is about to pay off in many ways. We'll see as we move forward through this year. But again, looking at the price and consensus chart, he's been in it since all the way back here in 21. And maybe even, I think they bought, one of the lieutenants bought in late 2020, even when the oil prices collapsed. And then we had the big position by Buffett, and the shares really going nowhere for all these years, but he did get a dividend, not that much different than what he's getting for his cash. And I think he thought that's a bargain for these assets. And when oil rises, which it always does, it will be a value and a good place to have parked this money. So this is something to watch on all of the energies. And we're going to look at Occidental now, because he's been adding to that position the last numerous years. He's a big shareholder of Berkshire Hathaway, is now in Occidental Petroleum. They're having a changeover in their CEO, who had a close relationship with Warren Buffett. So it's kind of interesting that Buffett and the Oxy CEO are leaving at basically the same time. But Occidental has never been my favorite on the energy stocks. It has a lot of debt. And if I was going to buy one, this isn't the one I would buy. And I haven't owned it in the value investor portfolio here at Zacks or my own personal portfolio for a long, long time. I might have owned it maybe 20 years ago, back when oil stocks were king in that decade, when Buffett was buying old economy stocks, and they were doing well while tech was in that bear market. But he's in it, and I feel like he's just decided it's cheap too. Let's just add to our position and get a big position in this one. And a lot of people have been wondering whether or not they would just buy Occidental outright. They could afford it. You can see the market cap over here at 58 billion. Well, they have 400 billion sitting there, so they could easily afford to buy it outright. But he has always said he didn't want to buy it outright. So we'll see. Will Greg Abel want to buy it outright? We'll see on all of this. They do pay a dividend, but you can see how good Chevron's is, because they're only paying 1.77%. They are a producer, not big oil. They have never had refining. They did have chemicals, but they're spinning off the chemical unit now. So it's just going to be a producer. And I do like the pure play producers when oil is surging. That is where you want to be. They're mostly unhedged. And so that's where the earnings growth will be the strongest. And we don't have to worry about all those other businesses and jet fuel and gasoline and all of that. We're just getting oil out of, and natural gas out of the ground. So you can see on this price and consensus and surprise chart, it's much like Chevron's. The earnings were down, down, down until this year with the war, and now they're not. And the same with the shares. They were down, 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 a little bit different than Chevron's, who are mostly staying stationary. But these shares have been weakening. A lot of the producers hit new multi-year lows in 2025, when it appeared that oil was going to take a lot longer to rebound. And the Saudis started producing more, virtually guaranteeing that it would, until now. So we have the surge in the stock. It's not back to the 2022 highs yet. And it too sold off when oil plunged back down to 80, but it is on the way back up. It is expected to report shortly, so we don't have the earnings in yet, but it's got the number one rank as well, because in these detailed estimates, you will see the analysts have already been pricing in all of this oil, the increases in the prices. And so we do have the estimates on the rise. But this is interesting. So for the full year, it is pretty dramatic. They were only supposed to make 59 cents before the war. That's pretty low because that dividend was higher than 59 cents and now 4.54. So that's not even just a doubling there. That is an incredible increase in 1 year. But again, we do see this with commodities plays, and it's going on right now. A year ago, they made 221. So big difference expected for this year with a decline back all the way down to 59 cents. But oil was expected to go back into the 50s, and you're just not making much money with oil in the 50s. But we're not there right now. We're over 100 again. And so this is the result of the earnings. So we still did have four estimates down in the last 30 days. So a lot of analysts trying to get in control of what's going on. And then next year, pretty bullish again for next year with the estimates rising, but a decline because no one expects oil to remain above 100 for, a very lengthy amount of time. But we'll see. A lot can change. So they have a good earnings surprise track record, but estimates are all over the place for this quarter. Unclear if they're going to beat again this quarter, but I'm expecting it. And the most accurate estimate is expecting it too, with 74 cents versus the consensus of 62. Look at this accurate estimate over here for the full year at 532. That's a lot higher than the 454. So even most recently, the analysts are getting more bullish that these higher prices are going to extend through the later part of the year and really juice these earnings. Now, these are the only two energy stocks owned in the Berkshire equity portfolio. But I did want to take a quick look at a third one that always reminds me of a Berkshire type of stock, Diamondback Energy. Its major drilling is in the Permian. It is one of the bigger drillers, also a market cap of 58 billion, so close to Occidental. Paying us a dividend a little bit higher than Occidental, 2%. They haven't reported yet either, but they're also a number one stock because, again, earnings are on the rise. But look at what's happening to these shares. They're trying to bust out here because it is a better, well-known name in the oil space, well managed, and it doesn't have the debt load of an Occidental. So you can really see these earnings on the rise again, and the shares doing the same thing, trading only at 11 times because, again, even with those shares trying to bust out, the earnings are going up at a faster rate. Now, looking at those detailed estimates, I did want to see ahead of the earnings report here what the analysts are thinking with a stock like this. Okay, so they're much more bullish in just the last week before the earnings come in on Diamondback here, and they're expecting to see even more bullish than they thought 30 days ago. Two are higher across the board, both for the quarter and the year and next year. And we are now seeing pretty good earnings gains here. 875 90 days ago for the full year, now 1884. That's what I like to see as an investor. And the most accurate estimate, though, is right at that consensus. So I am kind of surprised it's not more bullish like we were seeing in Occidental, but we didn't have any recent estimates of in the last week with Occidental, and now with Diamondback we do. So it's jumping immediately up to the most accurate is the current, and that is also bullish. So this is another big name I'm going to be watching during this earnings season and as these oil prices remain elevated. I still like the commodities plays in general, including gold miners, but gold appears to be moving opposite of oil right now. Whenever we get a bid on oil, we get a sell-off in gold, but I still have high price targets for gold through the end of this year of around 6,000 an ounce. It's about 4,500 right now as I'm recording this. So it's got a ways to go. 5,500 thereabouts was the all-time high, but we'll see as we move forward if depends on what's going on out there, and even with what's happening with oil here, because like I said, it does seem to be moving in opposite direction of oil market right now. So we've got great Zacks ranks on a lot of the oil stocks because of the immediate increase in the earnings that are going to happen there. They're almost all unhedged, at least a portion of their production, if not all of their production. So they're really going to be the beneficiaries of this price spike in oil that is sticking around at least for a couple of months here. So I am invested in these. I've been buying oil stocks. I don't own any of these three in either my insider trader or my value investor portfolio or in my own personal portfolio, but I own other oil stocks as well. And just to take a look at what's happening with the industry on the oil producers, I clicked on that link and we have 34 companies in here, and look at all the number ones. The first page, which is 10 companies, all number ones, and you have to go all the way to the second page. You're still getting a couple. So 13 number ones out of 34 companies. And then look at all those number twos, about 10 of those as well. So 20 out of 34 are number ones or number twos. Then we are getting some. And some of these are going to be natural gas companies in here for the number threes. And natural gas hasn't seen the big increases, but we do have one number five, High Peak Energy there at number fives, no number fours. Not sure what's happening with High Peak. Maybe we should take a look because maybe we only have one analyst on it. Maybe they had to cut for some reason. Let's see. It is a small cap as assumed, 846 million. And we see a lot of misses there. So let's see, as we're going to look at the detailed earnings, just out of curiosity, no, we do have two estimates, but both are down. So we have both down for the full year, but in the last 60 days. I find it hard to believe that they're not trying to increase this one. We do have most accurate estimate is looking better though for the full year, a loss of only 8 cents versus a loss of 30 cents on the consensus. So somebody's a little more bullish, but still not into the green there. Let me look at if you go to the quote overview on these, you can see what area they're in. As we scroll down, it just says oil, natural gas, NGL reserves. So I'm not sure why they must be heavier into natural gas would be my guess on this company. But I'd have to look. High Peak Energy, though, with the number five. But with all those number ones and number twos, who cares about High Peak Energy? Everybody else is cheap. Their earnings are on the rise. Buy the most oily that you can, the companies that are bigger in oil production than in natural gas. And it's okay to buy some of those big oils. Let's look again at Chevron. It's a little different. It's not going to show up in this industry because it's the integrated side. And let's see what the Zacks rank looks like on the integrated side. Now, remember, with some of the integrateds, they're going to have operations in the Middle East, especially these that are international. And so some of their facilities may be down and they may have to have expensive repairs. So that will go into impact earnings. But look at out of 17, the top 10 are all number ones. And we have no number fours or number fives. So everybody's pretty bullish on this group overall, including Exxon there. And Shell is also reporting this week as I'm recording this in early May. So keep an eye on these. They are cheap. And keep asking, what does Warren Buffett know? Why is he so heavily into cash right now? Well, we kind of know why, because valuations are stretched in many companies, but there's always a bull market somewhere. And right now, it appears to be in oil and also some of the old economy companies that are involved in the AI revolution trade, not on the tech side, but in actually building the data centers, building the power generation, the heating and the cooling of these data centers, those kinds of things that are kind of older and boring. And in companies that have been around, say 70 to 100 years or more, they are all being the big beneficiaries. And Berkshire, outside of its equity portfolio, owns a lot of those companies outright, a lot of old economy companies that going to have exposure and benefits to what's going on in the AI revolution. So this could be the decade for Berkshire Hathaway, especially on the commodity side, as if oil remains elevated. And it has about 11% of the equity portfolio now in these oil positions. So it doesn't take much as long as you have some exposure. And I recommend that investors do have exposure to the oil trade now. There's a lot to choose from, a lot of great companies. Check out their earnings reports and have some exposure here as we move throughout 2026 and into 2027. And as always, we aim to bring you what is going on out there in the markets and the economy every week here on Zacks Pro. So join me and my colleagues here next week with some more stocks.